Welcome back to the channel. In today's video, I want to strip investing down to its essentials. Because let's be honest, when you open up an investing app or search for ETFs online, you're bombarded with hundreds, even thousands of choices. And most investors, they end up spreading themselves too thin, chasing performance, or buying funds they don't fully understand. But here's the truth, you don't need dozens of ETFs to build wealth. In fact, I believe that in 2025, you could hold just 3 ETFs and have one of the strongest, most balanced portfolios possible. And those 3 ETFs are VOO, QQQ, and SCHD. Throughout this video, we're going to dig deep into why I chose these 3, how they complement each other, how you can balance them, the risks you should watch out for, and even what kind of realistic returns you might expect over time. So, if you're tired of the noise, if you want to cut through the clutter and focus on what really works, then grab your notebook and stick with me, because this might just be the cleanest, most powerful investing plan you'll see all year. Before we dive into the ETFs themselves, I need to make the case for simplicity. Because when I tell people you only need 3 ETFs, I get pushback. I hear things like, but what about international stocks? What about small caps? What about real estate? And those are fair questions. But here's the thing, the more complicated your portfolio gets, the harder it becomes to manage. You start second-guessing, wondering which ETF is underperforming, debating whether to sell or buy more, and before you know it, you're stressed out and paralyzed. The beauty of a simple portfolio is that it forces discipline. You can automate your investments, ignore the noise, and let time do the heavy lifting. Think about it like building a house. You don't need 100 different tools, you need the right foundation, a strong frame, and a reliable support system. That's exactly what VOO, QQQ, and SCHD give you, a foundation, a growth engine, and a source of income. So let's break these down one by one. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. First up, we have VOO, the Vanguard S&Amp P500 ETF. This is your foundation. It tracks the S&Amp P500, which is basically the 500 largest companies in the United States. When you buy VOO, you're not betting on a single company, you're owning a slice of the US economy itself. Let's talk details. VOO's expense ratio is just 0.03%. That means for every $10,000 you invest, you're paying only $3 a year in fees. Practically free. And what do you get for that tiny fee? Exposure to companies like Apple, Microsoft, Amazon, Nvidia, Berkshire Hathaway, Johnson & Johnson, the list goes on. These are businesses that power not just the US economy, but the global economy. Now, why do I call VOO the foundation? Because historically, the S&Amp P500 has returned around 10% annually over the long term. That means your money doubles roughly every 7 years. And while there are ups and downs, recessions, bear markets, corrections, the long-term trend has always been up. VOO gives you stability and diversification across multiple sectors: tech, healthcare, financials, consumer goods, energy, and more. And here's the kicker, you don't have to worry about replacing companies. If a company falls out of the S&Amp P500, it gets replaced by a stronger one. The index naturally refreshes itself. So with VOO, you're essentially outsourcing your investing to America's biggest, strongest companies, while paying next to nothing in fees. That's why it's the core. It's steady. It's proven. It's long-term wealth building at its finest. Now, let's add some rocket fuel to the portfolio, QQQ, the Invesco QQQ Trust. This ETF tracks the Nasdaq 100 index, which includes the 100 largest non-financial companies listed on the Nasdaq exchange. What does that mean in practice? It means QQQ is heavily tilted toward technology and innovation. We're talking Apple, Microsoft, Nvidia, Amazon, Meta, Google, Tesla, basically the companies driving the future. QQQ has an expense ratio of 0.20%, a little higher than VOO, but still very reasonable for the kind of growth exposure you're getting. Why do I include QQQ? Because while VOO gives you broad stability, QQQ gives you access to cutting-edge growth. Over the last 10 years, QQQ has absolutely crushed the S&P 500 in terms of returns. Yes, it's more volatile, there are bigger swings, but those swings often come with bigger rewards. Think about the megatrends shaping our world right now: artificial intelligence, cloud computing, semiconductors, renewable energy, e-commerce. These aren't just buzzwords, they're the backbone of global innovation. And QQQ is positioned right at the heart of it. By adding QQQ to your portfolio, you're saying, I don't just want steady returns, I also want exposure to the companies defining the next 20 years of growth. Is it risky? Sure. Tech stocks can drop hard in downturns. But over time, innovation has always created new wealth. That's why QQQ is the growth engine of this 3 ETF strategy. Finally, we need something that pays you while you wait. Enter SCHD, the Schwab US Dividend Equity ETF. SCHD focuses on high-quality companies with a strong history of paying and growing dividends. In 2025, it's yielding somewhere around 3.5% to 4%, which is fantastic in today's market. It has an expense ratio of just 0.06%. Practically nothing. Some of its top holdings include Broadcom, Cisco, Pepsi, Coca-Cola, Verizon, companies that not only generate steady profits but also reward shareholders directly with cash. Why SCHD? Because dividends are powerful. They provide real income, they can cushion your portfolio during downturns, and when reinvested, they compound your returns over time. Picture this: even if the market goes sideways for a couple of years, SCHD keeps paying you. That income gives you flexibility, you can reinvest it for faster growth, or you can use it to cover expenses if you're in retirement. It's the ETF that makes sure your portfolio doesn't just look good on paper, it puts money in your pocket. Okay, so now we've got our 3 players, VOO, QQQ, and SCHD. The question is, how do we balance them? Here's one allocation that I think makes sense for most investors: 50% VOO, your stable foundation. 30% QQQ, your growth engine. 20% SCHD, your income stream. This balance gives you diversification across the US economy, exposure to high-growth tech, and steady dividends. Now, that's just one example. If you're younger and more aggressive, you might tilt more toward QQQ. If you're closer to retirement, you might prefer more SCHD. The beauty is, you can adjust the percentages based on your goals and risk tolerance. But the key takeaway is this: together, these 3 ETFs cover nearly everything you need. Broad stability, explosive growth potential, and reliable cash flow. Now, let's talk risks, because no investment is risk-free. With VOO, the risk is tied to the overall US economy. If America slows down, so does VOO. With QQQ, the risk is volatility. Tech stocks rise fast, but they also fall hard. Expect big swings. With SCHD, the risk is dividend cuts. Companies can reduce or eliminate payouts during tough times. That's why the three work best together. Each offsets the weaknesses of the others. Diversification doesn't eliminate risk, but it balances it. So how do you actually put this into practice in 2025? One word: consistency. Whether you have $500 or $50,000, the key is to invest regularly. Use dollar cost averaging. Automate your contributions each month. Reinvest your dividends. Don't worry about timing the market. Don't panic when prices dip. In fact, dips are opportunities. Over time, the combination of VOO, QQQ, and SCHD, plus your consistency, will build serious wealth. Let's be realistic about returns. VOO, historically about 8 to 10% annually. QQQ, historically 12 to 14% if tech continues to lead. SCHD, 7 to 9% with dividends included. Put them together, and a balanced portfolio could target around 9 to 11% annually over the long term. That's enough to double your money about every 7 years. Not flashy. Not overnight. But powerful over decades. So here's the bottom line: you don't need 20 different funds. You don't need to chase the hottest stock. You don't need to time the market. All you need are the right tools: VOO for stability, QQQ for growth, and SCHD for dividends. That's it. 3 ETFs. One simple plan. A lifetime of potential financial freedom. Stay consistent. Stay patient. And remember, wealth is built slowly, then suddenly. Thanks for watching. If you found value in this breakdown, do me a favor, hit that like button, subscribe if you haven't already, and drop a comment below telling me, if you could only choose one ETF in 2025, which one would it be?